What if everything you think you own isn't really yours? Your home, your car, even your country's economy. What if the wealth of the modern world, the skyscrapers, the booming markets, the growth we celebrate is all built on something that doesn't actually exist? Today, we're uncovering one of the greatest paradoxes in economic history, how credit quietly replaced reality, and how the illusion of prosperity became the foundation of our global economy. Because somewhere along the way, money stopped being a reflection of what we had, and became a reflection of what we owed. This is the story of how the world abandoned real value and replaced it with promises, debt, and digital numbers on a screen. Stay until the end, because understanding how this happened may completely change how you see your savings, your government, and the entire financial system around you. To understand how credit took over reality, we have to go back to a time when money meant something tangible. For most of human history, value was physical. It was gold, silver, land, or labor. Money was simply a tool, a token that represented something real. In ancient Lydia, around 600 BC, the first coins were minted, small pieces of metal that symbolized stored value. They couldn't be printed infinitely. They were finite, measurable, and scarce. For centuries, this tangible link between money and value kept economies grounded. Empires could expand only as far as their gold reserves allowed. But that limitation, that grounding in reality, also frustrated kings, merchants, and bankers. Because if money was limited, so was power. And that frustration gave birth to one of the most transformative inventions in economic history, credit. The roots of credit stretch back to medieval banking houses, families like the Medici in Florence and Fuggers in Germany who discovered that lending out promises could make more profit than trading physical goods. Instead of waiting for gold or silver to exchange hands, they began writing paper IOUs, early versions of debt instruments that represented claims on future payment. These were revolutionary. A merchant could borrow today, trade immediately, and repay later, fueling faster trade and economic expansion. But something subtle began to shift. We started to treat promises as wealth. By the 1600s, entire nations were borrowing money to fund wars and colonial expansion. The Dutch East India Company, arguably the first multinational corporation, issued shares backed not by gold, but by expected profits. When the Bank of England was founded in 1694, it created a financial model that still defines the world today. The state would borrow from private bankers who would issue notes in exchange paper-backed not by gold but by government debt. It was genius and dangerous, because for the first time, money wasn't created by producing something of value. It was created by borrowing against the future. As the 18th and 19th centuries unfolded, credit became the engine of the Industrial Revolution. Factories, railways, and entire cities were financed with loans. Nations competed not just with armies, but with debt-fueled economies. Governments realized that with credit, they could build faster, fight longer, and expand endlessly, even if the money wasn't there yet. Banks loved it, because every loan created new money. If a bank lent you £1,000, that money didn't exist before. It was literally created through the act of lending. This process, later known as fractional reserve banking, allowed banks to create money out of thin air, with only a fraction of deposits held in reserve. It was as if reality itself had been rewritten. Money could now be conjured by typing numbers into ledgers. But the system relied on one crucial assumption, that the future would always deliver enough growth to repay the debt. That illusion began to falter in the 20th century. In 1929, the Great Depression exposed the fragility of a system built on credit and speculation. The Roaring Twenties had been fueled by cheap loans and margin debt, and when confidence vanished, the entire pyramid collapsed. Banks failed. Savings vanished. Millions were left destitute. It was a brutal reminder that credit expands prosperity but also multiplies collapse. To restore order, world leaders sought to rebuild confidence in money itself. After World War II, they created a new system at Bretton Woods, pegging global currencies to the US dollar and the dollar to gold. It was a hybrid between the old world of tangible value and the new world of credit, but even that balance didn't last. In 1971, US President Richard Nixon made a decision that would redefine global finance forever. He ended the dollar's convertibility to gold. Overnight, money was no longer backed by anything real. From that moment on, every dollar, euro, or yen was backed only by trust, the belief that others would accept it tomorrow. Reality had been replaced by confidence, and credit became the oxygen of the entire global economy. Once money lost its anchor, something extraordinary happened. Debt exploded. Governments discovered they could issue infinite bonds. Banks discovered they could lend infinitely, constrained only by demand. Consumers discovered they could live beyond their means indefinitely. Credit cards, mortgages, and loans turned entire populations into perpetual borrowers, and the world celebrated it as progress. In the 1980s, the Reagan and Thatcher eras supercharged this transformation. Deregulation allowed finance to expand unchecked. Wall Street turned debt into products, mortgage-backed securities, derivatives, and credit swaps instruments so complex that even experts struggled to explain them. These were the building blocks of what economists call the financialization of the world, where real productivity mattered less than paper profits generated from debt. Every loan created new spending power. Every dollar of debt inflated asset prices. Stocks, real estate, and commodities soared, making the rich richer and trapping the poor in cycles of repayment. It felt like growth, but it was synthetic. Because the foundation wasn't production, it was promises stacked on promises. By 2007, the illusion had reached its breaking point. Banks were leveraging 30, 40, even 50 times their capital, gambling on the assumption that housing prices would never fall. But when the US housing bubble burst, the entire structure collapsed. What followed was the global financial crisis of 2008, the most severe collapse since the Great Depression. In a matter of weeks, the fake prosperity of the credit era was exposed. But instead of letting the system reset, governments did something unprecedented. They created even more credit. Central banks printed trillions through quantitative easing, buying government bonds and bad assets to keep prices inflated. It was supposed to be temporary. It became permanent. By 2020, global debt had surpassed $300 trillion, more than 3 times the world's total GDP. In other words, for every dollar of real goods and services, there are $3 of promises to repay something that doesn't exist. Credit didn't just replace reality, it buried it. Today, the global economy is addicted to debt. Without constant borrowing, growth stops. If growth stops, asset prices fall, and if prices fall, the illusion collapses. So, central banks now perform a balancing act, keeping interest rates low enough to sustain borrowing, but high enough to prevent hyperinflation. It's a fragile equilibrium like spinning plates on poles. Every nation, corporation, and household is trapped in the same paradox. To stay alive, we must keep borrowing from a future that may never arrive. This is why economies celebrate rising GDP even when it's driven entirely by credit expansion, not productivity. It's why the richest 1% own more wealth than the bottom 99% combined, because those who control credit, the banks, funds, and central institutions, effectively control reality itself. Money has become an illusion of infinite supply, managed by algorithms and interest rates. And yet, beneath the surface, the real economy, the one that produces goods, services, and human well-being remains stagnant. As physical cash fades and digital currencies rise, the illusion deepens. Today, over 90% of all money exists only as digital entries, numbers stored in databases controlled by banks and governments. Central bank digital currencies, CBDCs, promise stability, but they also offer something else: complete surveillance and control. Every transaction traceable, every account programmable, every citizen's spending behavior invisible. It's the final evolution of the credit illusion, where money isn't just detached from reality. It becomes a tool for managing it. In this new system, financial crises aren't accidents, they're mechanisms of control. Inflation, deflation, and debt cycles become tools to shape behavior, not consequences to avoid. And the terrifying part, most people will never question it, because as long as the numbers in their accounts keep rising, they'll believe they're getting richer, even if reality says otherwise. Let's put the illusion into numbers. Global debt surpassed $315 trillion in 2024. The United States owes more than $35 trillion, growing by billions per day. The world's total derivative exposure, bets on credit, interest, and currencies, exceeds $600 trillion, more than 6 times global GDP, and yet, 60% of all countries are experiencing declining real wages. This means the world economy, isn't, expanding in real terms, it's expanding in claims on the future. We're living in an age where the appearance of prosperity, rising stock prices, higher home values, masks the decay underneath. It's a system that rewards speculation over production, consumption over creation, and dependence over freedom. And unless something changes, it will reach a point where promises can no longer be repaid and reality will have to return. Takeaway 1. Credit is not wealth. Wealth is what's produced, not what's promised. Credit can accelerate prosperity, but when it replaces reality, collapse is inevitable. Takeaway 2. Infinite debt means finite freedom. When governments, corporations, and individuals depend on credit to survive, they lose the power to say no. Debt becomes a leash, and control follows the hand that holds it. Takeaway 3. Every system built on illusion eventually meets reality. Whether it's the Roman Empire's debased coins, the 1929 stock bubble, or the modern derivatives market, history repeats one truth: you can't print real value. So the question isn't whether the illusion will end, it's when and how hard reality will hit when it does. Will the next collapse be another 2008-style bailout? Or will it finally mark the end of the era where credit replaces creation, and illusion replaces work? No one knows. But one thing is certain: the more we ignore reality, the harsher its return will be. Because in the end, credit may build castles in the air, but it can't build foundations that last. If you found this breakdown valuable, hit like, subscribe, and turn on notifications, because this is just one piece of the larger puzzle. In our next episode, we'll uncover how governments quietly inflate away your savings while pretending to protect the economy. Until then, question everything, especially the numbers that look too good to be real, because in today's economy, they probably are.